Good day everyone, I'm Beverly ABELLA from Base B, Track 3F, and I'm gonna discuss the Module 5, the advantages and disadvantages of unit credit. So what is credit? Credit represents a form of trust established between a lender and a borrower. If the lender believes that a prospective borrower has both ability and the willingness to repay money, then credit will be extended. The borrower is expected to live up to that trust by paying the lender. For the privilege of borrowing, a lender requires that the borrower pay interest and some other charges, such as processing fees. One can distinguish between and good bad uses of credit. Among the good uses are mortgage loans to buy a home, loans to open a business, and student loans. These uses are seen as wise choices because the funds are invested in ways that have a long-term payoff. Bad uses of credit include using a credit card to support a lifestyle that you could not otherwise afford and taking out loans to buy overly expensive and otherwise unaffordable vehicles. Credit can be used in a very positive ways to enhance personal financial planning. And the following are the sum of the reasons people use credit. For convenience, using credit cards simplifies the process of making many purchases. It provides a record of purchases, and it can be used as leverage if disputes later arise. Convenience use of credit is growing. For example, many of us now use credit cards at the grocery store and the gas station. Convenience use is justified only if the balance is paid in full each month. After all, you do not want to be paying for today's restaurant meal for months or years in the future. For emergencies, consumers may use credit to pay for unexpected expenses such as emergency medical services or automobile repairs. To obtain an education, the high cost of education has forced many students to use loans. This may be one of the better uses of credit as the borrower is investing in himself or herself to raise the quality of the life and income in the future. Despite its benefits, the use of credit has downside. Negative aspects include interest cost, the potential for overspending, credit's negative effect on your financial flexibility, and concerns about privacy. Use of credit reduces flexibility. The greatest disadvantage of credit use comes from the loss of financial flexibility in personal money management. The money that you pay each month on your debts is money you could have spent elsewhere on other opportunities. Credit use also reduces your future buying power, as the money you pay out on a loan includes a finance charge as well as the principal. In fact, credit can be seen as a promise to work for the creditor in the future to pay off the debt. It is tempting to overspend. A major disadvantage of credit is that its use often leads to overspending. Using a credit card to buy $425 worth of new clothes and paying $25 per month for 20 months, a total of $500. $425 and $75 interest charge may seem less painful than paying cash for a planned purchase of 300 worth clothes. The problem is this: once you begin carrying credit card debt, it may seem easier to buy more on credit, especially if you have more than 3 or 4 cards, as is typical for US credit card holders. Over indebtedness can be a real problem for credit users. Consumers with monthly non-mortgage debt repayments amounting to 16% of monthly take-home pay or more are considered to be seriously in debt. Misusing credit and not paying bills on time can give a consumer a poor credit reputation, damage employment prospects, increase the rates paid for insurance, and sometimes result in the loss of items purchased. Interest is costly. Interest represents the price of credit. It is the rent you pay while you use someone else's money. When stated in dollars, interest makes as part of the finance charge, which is the total dollar amount paid to use credit, in, including interest and any other required charges such as a loan application fee. The truth is, Lending Act requires lenders to state the finance charge both in dollars and as a manual percentage rate or APR. The APR expresses the cost of credit on a yearly basis as a percentage rate. For example, a single payment, 1 year for loan for $1,000 with a finance charge of $140 has a 14% APR. Knowing the APR simplifies making comparisons among credit arrangements. The lower the APR, the lower the true cost of the credit. The APR can be used to compare credit contracts with different time periods, finance charges, repayments, schedules, and amounts borrowed. Many states have usury laws, sometimes called small loans laws, that establish the maximum loan amounts, interest rates, and credit-related fees for different types of loans from various sources. These maximum rates can vary from 18% to as much as 54%. The laws of the state in which the lending institution is located apply, rather than the laws of the state in which the borrower lives. These regulations apply to the annual fee, late payment fee, and other fees charged on a bank credit card.
Good day everyone, I'm Leona SOLAS and I'm here to discuss to you on what is debt and there are 3 ways on how to set your own debt limit. So what is debt? Debt can be simply understood as the amount owed by the borrower to the lender. A debt is a sum of money that is borrowed for a certain period of time and is to be returned along with the interest. The amount as well as the approval of debt depends upon the creditworthiness of the borrower. So it is the sum that the person borrows from the other is called a debt. Debt is an amount of money one borrows and has to pay back later. Everyone, be it an individual or a corporate firm, has a debt at least once in a lifetime. Before taking debt, one must be very careful because the amount repayments is always higher than the sum borrowed. Moreover, debt always comes with a fee. The credit providers always charge a certain amount on the credit or the debt, which is known as interest. What are the 3 ways to set your own debt limit? Number 1 is set your own debt limit. To prevent your level of debt from getting out of control, you should determine your debt limit. A debt limit is the overall maximum amount of a debt you should owe based on your ability to meet the repayment obligations. Assess your income and expenses. The first step in setting your own debt limit is to have a clear understanding of your monthly income and expenses. This involves creating a detailed budget that lists all sources of income and all expenses, including fixed expenses like rent for a mortgage payment and variable expenses like groceries and entertainment. This will give you a clear picture of how much money you have available each month to allocate towards your debt repayment. Number 2 is debt payments to disposable income method. So what is debt to income or DTI ratio? The debt to income or DTI ratio is the percentage of your gross monthly income that goes paying your monthly debt payments, and it is used by lenders to determine your borrowing risk. To understand more the debt to income or DTI ratio, a low debt to income or DTI ratio demonstrates a good balance between debt and income. In other words, if your DTI ratio is 15%, that means that 15% of your monthly gross income goes to debt payments each month. Conversely, a high DTI ratio can signal that an individual has too much debt for the amount of income earned each. Here are the key takeaways. A debt-to-income ratio measures the percentage of a person's monthly income that goes to debt payments. A DTI of 43% is typically the highest ratio a borrower can have and still gets qualified for a mortgage, but lenders generally seek ratios of no more than 36%. A low DTI ratio indicates sufficient income relate to debt servicing, and it makes a borrower more attractive. Number 3 is ratio of debt to equity method. The debt-to-equity ratio is a financial leverage ratio that can be helpful when attempting to understand a company's economic health and if an investment is worthwhile or not. It is considered to be gearing ratio that compares the owner equity or capital to debt or funds borrowed by the. To understand more, it is used in corporate and personal finance. The debt-to-equity ratio is a metric that evaluates your company's financial leverage. In other words, it lets you to determine how much a company finances its operation via debt as opposed to owned funds. It's referred to as the personal debt to equity ratio when used with personal financial statements. The debt to equity ratio helps you to determine if there's enough shareholder equity to pay off debts. If your company were to face a decrease in profits, keep in mind that the debt of equity ratio calculation risk change incurred from earnings, losses, and other adjustments. A company's debt to equity ratio also varies across industries as amounts of debt change by sector. This ratio compares a company's total liabilities to its shareholders' equity. It is widely considered one of the most important corporate evaluation metrics because it highlights a company's dependence on borrowed funds and its ability to meet those financial obligations. Because debt is inherently risky, lenders and investors tend to favor businesses with lower debt-to-equity ratios. For lenders, a low ratio means a lower risk of loan default. For shareholders, it means a decreased probability of bankruptcy in the event of an economic downturn. A company with a higher ratio than its industry average, therefore, may have difficulty securing additional funding from either source. And that's all. Thank you. And may I call Mr. NEPOL to discuss the next topic.
Good day everyone, I am Christian and I will discuss obtaining credit. What is credit? Credit refers to arrangement where goods, service, or money are provided to a borrower in the present with understanding that the borrower will repay the lender in the future. Often with interest, it is essentially a trust-based transaction between a two parties, the lender who extends credit and the borrower who receives the credit. Credit is easily accessible in today's society, often offered to customers at a retail store like Target or Home Depot. However, individuals with no credit history or poor credit record may face challenges in obtaining credit. Success in securing credit depends on understanding the credit approval process and maintaining a positive credit reputation through responsible financial management. And we will proceed to the credit approval process. They have five criteria that called 5C. There are the capacity, capital, character, collateral, and condition. First, we will go to the capacity. Capacity is evaluate the borrower ability to repay the debt lenders examine factors such as income, employment, stability, and debt to income ratio to determine if the borrower has sufficient financial resources to make timely payment on the credit card balance. Second, the capital. Capital refers to the borrower's financial asset and net worth. Lenders consider the individual's asset, savings, and investment as a measure of a financial stability and ability to absorb potential losses. A higher capital position may indicate a lower credit risk to the lender. Third is the character. Character refers to the borrower's credit history and repay behavior. Lenders assess whether the individual has a history of making timely payment on debt and honoring credit agreement. A positive credit history demonstrates reliability and responsibility in managing credit. Fourth, the collateral. Collateral refers to asset that the borrower pledged as a security for a credit card debt. While the credit card are typically unsecured, meaning they do not require collateral, some lenders may offer secured credit card and require a deposit as a collateral. Collateral provides lender with recourse in event of default, reducing the risk of associated and extending credit. And last, conditions. Conditions encompass an external factor that may impact the borrower's ability to repay the debt, such as economic conditions, industry trends, and regulatory environment. Lenders consider this factor when assessing the overall risk of extending credit to a borrower. Additionally, lenders may also evaluate the purpose of the credit card application and how it aligns with the borrower financial goals and circumstances. By evaluating these 5C, credit lenders can make informed decision regarding credit card approval, ensuring the borrowers are capable of managing credit responsibility and repaying their debts. The credit card reputation. Your credit card reputation stored in credit bureau files plays a pivotal role in financial transaction and decision beyond just obtaining credit. Lenders are really on this information to assess your credit worthiness and when you apply for a loan or a credit card. However, it's not just lenders who take note. Potentially employers, insurer, or landlords also securitize your credit history to gauge your reliability and trustworthiness. Given it given in its far researching implication impressive to prioritize building and maintaining a positive credit reputation. This involve practicing responsible credit management, such as making timely payments, keep, keeping credit card balance low, and avoiding excessive debt accumulation. Regularly reviewing your credit reports for accuracy and addressing any discrepancies promptly is also crucially in ensure that your credit file reflects your true financial standing. By, ac- by actively managing your credit reputation, you not only improve your chance of obtaining credit but also enhance your opportunity in areas such as employment, insurance, and housing. Ultimately, a positive credit reputation serves as a valuable asset in achieving financial stability and success.
10 sign of over-independentness. First, high debt to income ratio. When your monthly debt payments are a significant portion of your monthly income, it indicates that you have may taken on too much debt. Second, difficulty making minimum payments. If you struggle to make even the minimum payments on your debt each month, it's a sign that your debt load may be too high. Third, using for your necessities. Constantly relying on your credit card or loans to cover up basic living expenses like grocery, utility bills suggest a financial imbalance. Fourth, mix out credit cards. If your credit cards are constantly maxed out or close to their limits, it's a sign that you are relying on heavily on your credits. Number 5, regularly borrowing to repay debt. Taking out new loans or using one credit card to pay off another is a clear sign of financial strain or over-indebtedness. Number 6, ignoring bills or avoiding calls from creditors. Ignoring bills or avoiding calls from the creditors because you can't afford to pay indicates a serious financial problem. Number 7, no saving or emergency fund. If you have a little to no having or emergency fund, you may be relying too much on your credit to handle unexpectedly expenses. Number 8, feeling stressed about finances. Constantly feeling stressed or anxiousness about your financial situation, especially regarding your debts, is a red flag. And number 9, credit score deadline. A significant drop in your credit score can indicate that your debt level are becoming unmanageable. And last, number 10, no clear payments plan. If you don't have a clear plan or strategy to paying off your debts, it's a sign that you may need reassess your financial situation and seek assistance if necessary.